You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Thursday. All right, so if you had the chance to buy a stock, add a stock to your portfolio with a 5% yield, paying their dividend monthly, that has been able to increase its dividend most of the time over the past few years, that did not cut the dividend during the COVID, and that is well diversified across many different industries. Would you be interested? Well, this is what I'm offering you today, a stock flying under the radar. Of course, far from being perfect, that's for sure, but definitely interesting. So it would be a nice time to take a look at Exchange Income Fund, which is not a fund, actually. It's really a corporation, but the name is Exchange Income Fund, IEF.TO. Full disclaimer, I do have a small position on this one in my Smith Maneuver portfolio, mostly due to the overall growth perspective and the fact that it has a good yield. So it's a good fit for this type of strategy. However, if we go into the business model, I must highlight the number one fact. IEF is a small cap. At 2.5 billion market capitalization, I would argue that it's really close being a small cap. If you look at the stock price, it is volatile, and smaller companies, especially operating into the aerospace and aviation sector, and also in the industrial sector for manufacturing parts. I'll get there in a second, but you can see that their ends are involved into a lot of different things. Well, big companies are usually operating in those industries. This one is a very small one, so you have to be careful about how it could get impacted by a competitor or a change in the economy. So you really have to be careful on this one. Once again, those are not buy or sell recommendation. You have to do your due diligence, my friend. All right, so aerospace and aviation, that is 60% of their business. Most of it is actually offering essential air services. So they do offer transportation into remote part of Canada in the northern regions, which is actually a highly lucrative business. On the other side, you have manufacturing, and they're not necessarily just doing parts for aerospace and aircrafts, but actually have like three different segments. So environmental access solutions, multi-story window solutions. Yeah, they're making windows on top of that, imagine. And then precision manufacturing and engineering. So that is roughly 40% of their business. And one thing that is super interesting to note is that the aerospace business, that is 60% of the revenue, is a lot more profitable. So for 2024, for the full year, we're talking about a profit of 524 million for aerospace segment, and then the manufacturing business generated 153. So we're talking like more than 3 times the profit for the aerospace, which, I mean, worth it to note it, right? So what's the investment thesis here? What's the narrative? So the narrative, well, first, while the aerospace business is highly cyclical, they benefit from a strong moat there because they have contract with government. So very sticky business for the remote region. So that is one thing that is great. The second thing is the business is very well diversified, as I said, across multiple types of industries in the industrial sector, which makes it a little bit more recession resistant, especially for the manufacturing part, because it's a little bit more stable, even though it's less profitable. The manufacturing part is also highly specialized in various industries, so they're going more for niche, smaller markets than trying to do it at scale. And this is also a good example of a company that successfully grew by acquisition. So they are a serious acquirer. This is their main way to grow, because I mean, when you're looking at the overall transportation in up north, I mean, it is a sticky business, but it's not going to grow double digit. Same thing for the manufacturing part. It is stable business, but not much of an organic growth potential. One other interesting fact is the fact that they went through COVID even in a very difficult industries, right? So their manufacturing plants were closed. Of course, air services and aircraft, I mean, that was one of the worst segment to be in, and yet they did not cut their dividend throughout that period. So that was a quite impressive. They maintained a dividend throughout the entire period, paying their monthly dividend. Pretty rare for a small cap offering a yield of like 5% to be able to do this, and they actually did it well, so that's good. So now that we have looked at the narrative, it's always important to back this up with some numbers, and the way I do it is I use the dividend triangle, which is like the three foundation metric that I use to start all my analysis. So the revenue trends, the earnings per share, and the dividend growth trends. So for the revenue, let's take a look at this. We have something that is growing steadily, actually double-digit growth over the past 5 years. Of course, from 2020 to 2021, we got a little bit of a down there, which totally normal due to the COVID and stuff and the lockdowns. But after that, starting like mid-21 all the way up to right now, the revenue keeps on increasing double-digit, which is amazing. We have a similar situation for the earnings per share. Big drop between 2020 to 2021, then a big comeback. So that makes it like relatively flat, because since 23 all the way through 2024 till the end, it was not a big moment in terms of profit. So relatively stable, a bit on the down low side, which explains the reason why between 23 and 24 the stock price did not move much, actually decline. Right now, relatively stable around like $50 after reaching like a high of like roughly $60 at the beginning of 25. But with all the tariffs and all like the concerns, kind of makes sense that right now investors are like tempted to stay on the sideline. In terms of so we have concluded that the revenue is increasing, the earnings a little bit tougher, but now what up for the dividend? Well, it pays a monthly payment, which is great. It usually able to increase their dividend, but not all the time. So right now, for the past 5 years, we have a compounded growth rate of 3%, which sounds pretty cool. The latest increase was almost 5%, so 4.7% in 23. So nothing in 24. Now we're waiting to see if something's going to happen in 25. But the payout ratio right now, as earnings decline over the past few months, are getting around 100%. So I don't think they will increase their dividend in the coming quarters. Probably they're going to wait until generating a little bit more profit. On the risk side, well, it is a small cap. I will never talk about it enough. So it is vulnerable for a lot of things. The debt, I mean, it's great to grow by acquisition, but it's not always easy. The debt has pretty much doubled over the past 5 years. So bigger debt, weaker balance sheet, higher interest rate charges. So got to be careful with that. This is not like the type of stock that you want to have like a huge position in it, mostly because it's small and it has like it's still dependent on growing by acquisition. The aviation business is quite cyclical, so have to be careful about that. And on the other side, tariffs could also impact the manufacturing business. So we do look at an interesting play in the industrial sector with a lot of characteristics that income-seeking investors are looking for: monthly payment, high yield, stable business. I get that. The risks, though, are still there, and the dividend triangle is not the strongest one. Not super weak, actually, not that bad, but again, not overly excited about short term, especially with all the uncertainties. It would be normal to see that stock price going down in 25. But again, it could be also a very interesting moment to take a deeper look and maybe buy some shares if you think it could fit in your portfolio once you have understand the risk and you did your due diligence. If you are looking for companies with a very robust set of metrics, meaning that a company that is increasing their sales, increasing their profit, and increasing their dividend systematically over the past 5 years, you can download the Moose Market Rockstar list. So you can download it at moosemarkets.com/rockstars. And in that list, you'll have like an Excel spreadsheet covering about 300 stocks, Canadian and US, with only companies showing robust metrics for the dividend triangle. So revenue, earnings per share, and dividend growth positive for the past 5 years. Definitely a great place to start if you're looking for buying some opportunities right now on the market. So right, moves, that's enough for today. Tomorrow, we are going to talk about retiring with $3 million and generating some dividend out of it. How can we do that? And of course, it's a good problem to have, but it's more about the mechanic of how you can create the income coming from that portfolio that will be interesting. So we're going to look at different strategies. All right. So until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.